Hello everyone, welcome to our Egyptian online seminar group. First, Kim Kunzov, then if you have any questions, you can ask our speaker after his presentation. I have great pleasure of welcoming Gary Cokins. Gary Cokins is one of the top accounting thought leaders in the world. Gary Cokins is an internationally recognized expert, speaker and author in advanced cost management and performance improvement systems. He is the founder of analytical-based performance management, an advisory firm located in Cary, North Carolina. Gary received a bachelor degree with honors in industry engineering operational research from Cornell University. He received his MBA from Northwestern University. Gary began his career as a strategic planner and then served as a financial controller and operations manager. Gary began his management consulting career first with Deloitte Consulting and then with KPMG Consulting. Gary headed the National Cost Management consulting service for electronic data system, now part of HP. Gary was in business development with SAS, a leading provider of enterprise performance management and business analytics and intelligence software. His author's books are Performance Management, Finding the Missing Pieces to Close the Intelligence Gap, Performance Management, Integrating Strategy Executive, Methodologic Risk and Analytics, Activity-Based Costing Management, an Executive Guide, Productive Business Analytical and Supply Chain Costing and Performance Management. Now we will start our seminar with dear Gary Cookins.
Well, thank you, Mohamed, for the introduction and also for inviting me to be a presenter for your Egyptian online seminars. Just to clarify, it is a long presentation, so there may only be a few minutes at the end where Mohamed will basically unmute you where you can ask questions. Alternatively, you can directly email me with my questions. You may want to write my email address down. It's on this slide, gcokins@garycokins.com. If there are more questions that we can't get to, Mohamed will copy them into a Word document from your chat or questions in Zoom, send it to me, and I will answer them in 24 hours. So let's get going. Who am I? Well, Mohamed's already partly introduced me, but I want to cite that I did graduate in 1971 from Cornell University. And if you're doing the math, I am 75 years old, but I feel like I'm 45. Just to clarify why those books are there, I think that careers have a lot more to do with luck and circumstances than being smart and competent. I had two lucky breaks in my career. One of them was in 1988. KPMG struck an exclusive contract for training with Harvard Business School professor Robert S. Kaplan. Some of you may recognize Kaplan's name from the balanced scorecard, which I will be talking about, but he did the early pioneering work in activity-based costing. So I got recruited from Deloitte. I was at Deloitte 7 years. I loved Deloitte, but I didn't want to miss the opportunity to be trained by Kaplan. So for 5 years, I implemented ABC, and then I wrote a book, and that led to the other books. Incidentally, you do not need to buy the books. I don't want you to go to Mohamed and say, oh, this guy's trying to push his books. Like, no, don't buy them. But if you go to wiley.com, WILEY, chapter 1 is typically a free download. The second lucky break I had was when I was a division controller, age 27, in Milwaukee, Wisconsin. I had the chance after a couple of years in the division finance controller to become plant operations manager. And I use the phrase, I then had to eat the accounting data I had previously been serving as the accountant upstairs. I found much of that information to be at best useless and at worst dysfunctional, misleading. And that was a real wake-up call to me about the difference between external financial statutory accounting reporting and internal management accounting, which is much more important. We'll talk about that later. So let's get going. Who will benefit from this presentation? Oh, well, and incidentally, I was raised in Chicago, a wonderful city. So those of you, if you ever get to the U.S., please come to Chicago. But I live in Raleigh, North Carolina, which is where the headquarters of SAS, Mohamed mentioned SAS. SAS is the world's largest privately owned software vendor, 15,000 employees that specializes in data science and analytics software. So, who will benefit? Professionals who have previously struggled at promoting financial planning and analysis, FP&A, enterprise performance management, EPM, and integrating business analytics into their decision support systems. Professionals who intend to champion any or all EPM and business analytic improvement techniques, and they need a compelling call to action. And the reason I have champion in quotation marks is it's been my observation that although it's nice to have senior executives advocate and sponsor new ideas and new innovations, often they are preoccupied with firefighting and short-term priorities. So it's typically managers 1, 2, 3 levels down in the organization chart who kind of are passionate and ask themselves, how long do I want our organization to continue to perpetuate using stale and arcane and flawed methods? And they're the ones that will do a pilot project or a proof of concept to demonstrate to their coworkers, other line managers, executives above them, that this is the way to go. So if you're young in your career and low down in the organization chart, that's fine. I like presenting to you. So my agenda, I'm going to first clarify the confusion and lack of consensus. What is this thing, enterprise performance management? I'll briefly talk about business analytics. Then I'm going to describe 8 pressures that have caused interest in organizations to implement some or all of these EPM methods. And then I'm going to drill down into 4 of them into more detail. At the very end, I'll conclude how does it all fit together as through integration. So let's say there was confusion and lack of consensus. If you just do an internet search on the 2 words, performance management, the hits are going to come up, the personnel function or human resources, employee appraisals. The issue here is enterprise performance management much broader. Is it scorecards, dashboards, key performance indicators, and measures? Yes, but that's a subset. Is it the alignment of such as strategic or resource allocation with the strategy of the executives? Yes, but that's also a subset. That'll be balanced scorecard. We'll talk about it. Is it process, productivity, and quality improvement? Yes, but those 3 are referred to as business process management, BPM. EPM is a much larger umbrella. So is it all of the above or even more? The good news is this. The enterprise performance management methods are likely not new terms that you're unfamiliar with. You've probably read business journals or articles about some of them. The problem is when organizations do implement them, they implement them in isolation of each other. So you've got cost and profitability department in one part of the building. You've got risk management in another part of the building. You've got planning and budgeting strategy in another part of the building. You've got process improvement, lean management, 6 in another part of the building. The issue is this. You get a lot more power and synergy when you seamlessly integrate all of these methods like gears in a machine, and even more power if you embed analytics of all flavors into them. So because I'm going to be providing Mohamed a PDF file after this talk, he'll be able to distribute these slides to you. You don't have to come ask me for them. So, and there is the definition I just described. It's the integration, multiple methods, each embedded with business analytics, such as segmentation analysis, especially predictive analytics, because that's about the future. But make no mistake, the purpose of all of this is to achieve the executive team strategy and for everyone to make better decisions. Now, briefly, what's business analytics? I could go to Wikipedia, and put a slide here with its definition, but my suggestion is work backwards with the end in mind. What do I mean by that? Think of a problem or an opportunity where one could apply some of these data science tools like correlation, regression, clustering, associations. Those are all in the data sciences toolbox. So regardless of how analytics should be defined, there should be no argument what is its purpose, and there it is, better decisions, better actions. Analytics goal should be to gain insights and foresight, that's the future, and to solve problems, make better and quicker decisions with more accurate and fact-based data, and then to take action. So I sort of lied to you. I wouldn't give you a definition. That paragraph at the bottom's pretty good definition. I have authored a book on predictive business analytics. Again, you don't need to buy it, but when you get these slides, if you click on the link at the bottom, chapter 1 is a free download, and it's a pretty good overview of the rest of the book. So when we think of analytics, we can put them on a continuum. Kind of think of it as stages of maturity. When we look at the historical view, last month, last quarter, last year, we start with descriptive analytics, pie charts, histograms. Then we move to diagnostic analytics. Notice there's a black dot there that's an outlier from the exponential curve. So we want to basically drill down with tools, business intelligence tools. Why is that outlier? Why is it unusual? Then we move to the future view. I call this the windshield, the predictive view. And when I co-authored that book I just showed you, I thought, well, that's Mount Everest. That's the highest level of maturity, predictive analytics. But in the last 4 or 5 years, there's been a higher level. It's called prescriptive analytics. You can think of it as optimization. So what are the 8 pressures that have caused interest? I'm going to take 3-4 minutes to go through each of these 8, and then the rest of the presentation, I'm going to go deep dive into 4 of them. Let's start with the first one, executives' frustration with strategy failure. Most executives are quite good at formulating their organization strategy. Their frustration is failure to implement and execute the strategy. And there's empirical evidence on this. There's an executive recruiting firm in Chicago that monitors the involuntary turnover of CEOs in North America, the firing of CEOs. It has been increasing every year. And I believe the reason is post-Enron, some of you are familiar with the Enron collapse that took out Arthur Andersen. They take their governance job far more seriously. So if the CEO is not implementing the strategy, they terminate them. A good example, Carly Fiorina with Hewlett Packard. She failed to fully implement the strategy. They terminated her. Number 2, increased accountability. Today, there is no place to hide. You will be monitored. You will be measured. It doesn't necessarily mean your job is at risk, but it could adversely impact your salary increases and job promotions. 3, more rapid decision making. Unlike a few years ago when you could test and learn and have meetings in conference rooms, today people will be on the phone, go or no go, yes or no. They have to make a decision in real time. They almost wish an executive was sitting next to them during that phone call and say, what should I say to align with your strategy? 4, mistrust of the managerial accounting system for transparency and accuracy. The reality is most managers do not trust the accuracy of the management accounting system. Why? Overhead cost allocations. Line managers hate that because they know it's flawed. I'll describe how activity-based costing resolves that. 5, poor customer value management. The reality is customers are the source of value and wealth creation for shareholders and owners. We need to connect actions with customers all the way to shareholders and owners. But we have a problem. The accountants are not measuring customer profitability. They're stopping halfway in the income statement with product and service line gross profit margin. 6, contentious budgeting, poor resource capacity planning. This may shock you. I believe the annual budget process is broken. It's a disaster. And my suggestion is stop budgeting. There, I probably caught your attention. But that begs the question, what was the purpose of a budget in the first place, and can we replicate it using these enterprise performance management methods? I'll show you how to do that. 7, dysfunctional supply chain management. Now, this may not apply to all of you. Some of you may actually be in the retail space, so you're selling to end consumers. But for those of you that are in a supply chain with trading partners upstream and downstream, the issue here is most customers treat their supplier as the enemy. It's an adversarial relationship. Let's try to negotiate a lower price from our supplier. If we put them out of business, they go bankrupt. So what? We'll get another supplier. That behavior has to stop. It needs to be a marriage. Supply chains are competing against other supply chains for share of wallet and purse. So they need to work together to identify mutually beneficial ways to save both of them money. And finally, 8, unfulfilled return on investment promises from large IT systems like enterprise resource planning systems, ERP. And the issue here is if you ask the chief information officer, the director of IT, 3 years after they've gone through the long journey of implementing the ERP system, you ask them, how well do you believe the return on investment from implementing the ERP system has met or exceeded the ROI that the software salesman sold you on 3 years ago? Many of them will say, I'm not sure. We put in a lot of work to implement this software. I'm not sure we've got the payback. That does not mean you shouldn't implement the ERP system. You have to, because your competitors have it. So you got to keep even with your competitors. But the issue here is ERP produces a lot of data, but not information. You convert data into information. And so the EPM methods, they do convert it into information and they create the ROI like growing seeds from the ground. So for the next 40 minutes, I'm going to do a drill down on these 4 of the 8 forces. Let's start with the first one that I already mentioned, failure by the executives to execute their well-formulated strategy. Excuse me. So in this diagram, you see 2 ellipses. I've got a strategy map going into the balanced scorecard. I'll get to that in a minute. But above the 2 of them is something arguably more important. It's the vision and mission statement. That must come from the executives. That's their job. They basically need to set direction for the company. They need to answer the question, where do we want to go? But what the strategy map and their balanced scorecards answer is a different question. How will we get there? What are the projects or initiatives to basically implement or core processes that we need to improve? So many organizations allegedly claim they've got a balanced scorecard with KPIs. I ask them, do you have a strategy map? They look at me, what's that all about? This may surprise you. I think the strategy map is 10 times more important than the balanced scorecard. The balanced scorecard is a feedback mechanism. You want to start with the strategy map. So the strategy map and its balanced scorecard, they're mechanical. They're like one of those gears meshed together in the machine. They help realize the vision and mission of the executives. Now, real quickly, here's a fictitious example of a typical strategy map. What Kaplan and Norton, Dr. Harvard Business School, Robert Kaplan and Dr. David Norton, who created this, what they recognized were 2 things: that executives were overreacting to financial results reported at the end of the fiscal period. They said you need to shift your attention to non-financial metrics collected during the period so you can react to them. And they created these 4 broad perspectives from bottom to top. And inside each of them, notice those rectangles are 2, 3, or 4 what are called strategic objectives. So if the employees are accomplishing, let's say, the 2 strategic objectives in the learning and growth, they'll contribute to the internal process improvement objectives. If they're accomplishing those, they'll contribute to the customer loyalty, retention, growth objectives. And then they'll ultimately, if you will, contribute to accomplishing the financial objectives. Now, those arrows, we call those are measures, KPIs, key performance indicators. You get what you measure. You can't measure it, you can't manage it. If you can't manage it, you can't improvement. Now, Kaplan and Norton also created this for another reason. Most managers don't understand the executive team strategy. I mean, for example, if I went into your organization, and incidentally, if there's any consultants listening to this, please directly email me. What I enjoy doing now is training you how to implement these methods for your clients. But regardless, whether it's a client or your organization, if I just randomly interviewed 10 employees in the hallway and said, quick, 3 minutes, can you explain and articulate your senior executive strategy to me? How many of them could do it or do it well? Probably none. So that's what this does, is it communicates. So to think of how this works, if we go from bottom to top, a learning environment will stimulate process excellence. That'll lead to customer intimacy, retention, and loyalty and growth, and that will create the financial value for the shareholders and the owners. A way to think about a balanced scorecard is imagine if every employee every day could answer this one single question. How am I doing on what is important? How am I doing on what is important? Well, the first half of the question is actually easily answered with a balanced scorecard. They turn their computer on, they may have 3 KPI dials. Is it favorable or unfavorable to the target that was set by the executives? The real challenge is the second half of the question on what is important. What are the KPIs that we should measure? So a strategy map and its balanced scorecard provides this answer. The overriding purpose of a strategy map and its balanced scorecard system is to make mission and strategy everybody's job. It's almost like making owners in the employees. Let's move on to the fourth of the 8 forces. Mistrust of the managerial accounting system and its flawed cost allocations and misleading cost reporting, outputs, products, standard service lines, channels, customers, and outcomes. Okay. To resolve this, you need activity-based costing. Now, some of you may have impressions that, oh, ABC, it's too complicated, it doesn't work. And I'll describe those problems did happen because the consultants and others were making their system way too large, way too complex than it needed to be. ABC does work. Here's a simple way to understand it. Imagine you go to a restaurant with 3 other friends. You order a little salad, the other 3 order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, hey, let's all split this check evenly. How do you feel? Not fair, not equitable. Well, that's how products and standard service lines feel in a traditional accounting system, costing system, when the accountants take this large amount of overhead, which more properly called indirect expenses, and they allocate it to the products and services like spreading butter across bread. In manufacturing, they may use the denominator, the number of labor hours, number of units produced, sales amounts, square feet, square meter, number of employees per department. None of those cost allocation factors reflect the unique consumption that the diverse products consume of the end-to-end business processes and the work activities that belong to those processes that in turn draw on the spending. So the simple definition of ABC is as if the waiter or waitress brings 4 individual checks. You only pay for what you consume. You just pay for your salad. You don't subsidize those other 3 with the expensive item. Now, the reason there's become interest in ABC in the last 70 years has to do with this diagram. It has the 3 universal components of any organization's expense and cost structure. You've got the direct recurring labor at the bottom, the material in the middle, and then the overhead, more properly called indirect expense at the top. Notice what's happening. Over time, the indirect expense is displacing the direct. And when you ask people why, they'll say, well, automation, machinery, computers, kiosks, that is secondary. The main reason the indirect is displacing direct is over time, all organizations have had an increased proliferation of different types of products, manufacturers, more colors, more sizes, more ranges, banks, more types of depository accounts, insurance companies, more types of loans and policies. Notice I keep referring to services. So if you think this is only for manufacturers, you're wrong. In fact, in the United States, only 8 out of every 100 jobs make products. The other 92 are doing services like insurance companies, travel agencies. So this is all universal. So the problem is, 50, 60 years ago, when the company had just homogeneous products, maybe just a few, the indirect was small. You could basically butter spread it. It would be not accurate, but most of the accuracy came from the direct. But now look at 2024 to the right. That's not the case. In many organizations, the indirect expense is over 50% compared to the direct. So how does ABC solve this? Problem is, most organizations only have the first, if you will, chart to the left, the responsibility center cost statement. Every manager in the planet Earth, including in Egypt, recognizes this statement: salaries, equipment, travel expenses, and so forth. But when a manager gets this report, they ask themselves, how much insight and understanding do I get about the cost that I can influence and control? And the answer is not much. They can't really see it. It's not that it's a bad report, it's a good report. It's just that the data in that report is structurally deficient. It's not structured in a way that can change it. So notice when we move to the middle box, key scan claims, analyze claims, we've shifted the same 914,500 US into the language of work. So we've shifted the data into information. Notice I'm using the back office of an insurance company. It's a factory too. Then we take each of the activity costs and we reassign them to the products and services, just like the waiter or waitress in the restaurant, based on their consumption level. So basically, I like to say, though, that when they only get the responsibility report, when managers get this kind of report, they're either happy or sad, but they're rarely any smarter. Activity-based costing makes them smarter. Now, I've rotated the previous slide 90 degrees. It isn't quite as simple as, oh, well, we take these ledger expenses, put them into these activity cost pools, and assign them to product services and so forth. It's more complex because we have, look at the right side, we have support departments that support other support departments that ultimately support the frontline departments that interact with customers and make products. It needs to be a multiple stage cost assignment network. Now, I want to warn you, the next slide is complicated. However, the slide after it will point you to a link to a 30-page paper that I wrote that describes it. But let me take you through it quickly. It's not as complex as you think. It's got the three universal components. We've got the resource expenses at the top. We've got the work activities in the middle, and then they pile up at the bottom into the final cost objects, products, services, customers, business sustaining. All of those arrows, think of them as thin straws or wide pipes where the diameter reflects the amount of money flowing through. That's why this always will reconcile exactly. So if the organization, let's say, spent $2 million or euros, it will, in the month of January, it will be the exact same 2 million of the work activities. And then the work activities will then pile up the same 2 million into the bottom two right boxes, the customers and the business sustaining. I'll talk about business sustaining in a second. In that box at the bottom, the final cost objects, think of this like the predator food chain. Large mammals eat small mammals, small mammals eat plants. You accumulate them through. Now, business sustaining is a special category. There will be some expenses that have nothing to do with interacting with customers or providing services or products to them. Things like the legal department or the accounting department when it's closing the books. We can't trace or assign it. There's no cause and effect relationship, and it's typically about 10% of an organization's expense. So we create a final cost object like senior management or board of directors who want this. Also, notice there's two red boxes in the middle that are not going to the products and services, they're going straight to the customers. Those types of expenses, activities would be marketing expenses, selling expenses, cost to serve, and the like. We'll talk about that. The message about this slide is costing is modeling. Costing is not T accounts and journal entries in a system. Again, I mentioned to you, I went through that fast. If you click on the link at the bottom, it's a statement of management accounting I created for the Institute of Management Accounting. I'm a 30-year member of the Institute of Management Accountants. There were, what I think, 140,000 members in 50 countries or more, I think even in Egypt. And I've written a lot of articles for them. Now, what's more important is what's the impact of ABC? This graph, the vertical axis is the percent error distortion. How inaccurate is it? The horizontal axis is that traditional butter spreading, labor hours, units produced, and so forth. The backwards S line is the ABC line, the result when you use that multi-stage cost assignment network. So here's the result. To the left, the simple products and services, this is like you in the restaurant ordering the salad, they will have been overcosted. of the indirect expense. But to the far right, for the complex products and services, they will have been undercosted. So you're actually losing money, but you don't realize that with the traditional costing. And the impact is serious. If we look to the left for those simple products, because they've been overcosted, the organization will probably mark up a higher price. But the competitors are going to see that high price and say, golly, ours is much lower price and we still make profit. So they're going to steal or grab market share from you. To the right side, it's more serious. The sales force will be of the false illusion impression that the products they're selling are very profitable. They're not. In fact, some of them may be unprofitable. So the more they sell, the more the company loses. Here's another way of looking at the outcome of activity-based costing, and you're looking at a true company's graph here. The vertical axis is the net revenues minus the properly calculated and traced ABC costs using the assignment network. The horizontal axis is the cumulative buildup of the profitability, but it's rank order starting with the most profitable product, the second most profitable product, and so forth. The very last data point at the right will exactly reconcile with the P&L of the company. So in this particular company, for their quarter, they had 30 million in sales, 20 in expense to net out of 2. The last data point is 2. When organizations see this graph, there's always organization shock. They can't believe it. In this particular case, the company, what it said is they made roughly $8 million of unrealized profit on 3/4 of their most profitable products. They lost 6 million on the remainder to net out of 2, and they can't believe it because their belief system is it's the blue line, everything's profitable, but maybe there's a few unprofitable at the end. And the problem was that butter spreading of allocations, labor hours, units produced was crushing or suppressing any accuracy, like a heavy weight on the blue line. And what ABC did was detect all of the differentials and created that curve at the top. These are typically referred to as whale curves because notice it looks like a humpback whale. Incidentally, the reason this graph looks kind of crummy is this was my very first ABC implementation with KPMG in 1988, almost 40 years ago. And these whale curves show up every time when people does ABC. The important thing to note is the top line is fact-based data. And if you remember anything from this 60-minute interview with me, I want you to remember this. In the absence of facts, anybody's opinion is a good one. In the absence of facts, anybody's opinion is a good one. But usually the biggest opinion wins, which is the opinion of the boss of the boss. So to the degree they're making decisions on intuition or flawed and misleading information like the blue line or office politics, your organization's at risk. Now, let's go to the fifth of the 8 forces, the shift from being product centric to customer centric. The only value a company will ever create is the value that comes from its customers, the current ones and the new customers acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, serve them more efficiently, and acquire relatively more profitable customers like the profitable customers that you have. But we have a couple of problems. The accountants are not calculating customer profitability. They're stopping halfway down the income statement at just product and service line gross profit margin. They're not including channel distribution expenses, marketing expenses, selling expenses, and cost to serve. Visually, what I'm saying is, let's say this entire rectangle was the spending for, let's say, the month of January. The accountants are only calculating cost for the shaded. And it would be nice if the indirect was using ABC principles, but they're not including distribution, sales, marketing, general accounting, and administration. Here's the next problem: angel customers and demon customers. What do I mean by this? Every company has high and low maintenance customers. Examples of high maintenance customers: always changing delivery schedules, always demanding special, not standard product, always returning goods, always calling help desk. Low maintenance customers, the angels, we love them. Never change delivery schedule, only buy standard, never call help desk, never return goods. If those two types of customers brought the same volume, same mix, same price, at the extremes, they're not equally profitable. because the high maintenance customers are causing so much extra effort that they're basically reducing the profitability. So the message here is sales volume is not synonymous or equivalent with the profit from each customer. But really, what really caught my attention with this book was not the main title, but the subtitle. Discover which type of customer is which and turbocharge your stock price. And as I said earlier, customers are the source of value creation for shareholders and owners. We want to connect them. Incidentally, this book was authored by 2 university faculty at Columbia University in marketing. It doesn't have much information about accounting. Now, this is a decomposition of the multi-stage cost assignment. I know it's complex. I'm not going to go through all of it. Again, if you download that statement of management accounting from the IMA, you'll see this diagram. But what's happening here is as the activity costs start coming in, piling up from left to right, they basically start stripping away layer by layer by layer the profitability. Typical ABC systems will have 50 to 70 activities. So think of 50 to 70. This then allows us to create a profit and loss statement for each customer. And it's layered like an onion skin, so you can see all of these contribution profit margin layers. Now, in this fictitious case of a customer, they had a 30% composite average gross profit margin for the profit and services. But between the 30 and the 8, 22 more points of profitability are eroded, nothing to do with delivering the products, all with the behavior of interacting. So if you calculate that 2 broad swath for every single customer, you can put them on a grid like this, where each customer is now an intersection circle. The vertical axis is the product mix gross profit margin, remember, above the line. And the horizontal axis is that below the gross profit line, the angels to the left, the devils to the right. And now things become obvious. The most unprofitable customers are in the bottom right because they're buying low profit mix margin from you and they're difficult to serve. The most profitable customers are in the upper left because they're buying high profit margin mix and they're easy to serve. And now the name of the game would be move the dots, the customers from the bottom right to the upper left. And Mohamed, that would be another seminar from another speaker that's got skills in marketing and sales. But an example that they would give in that seminar might be unbundling and fee-based. Look, the banks have been always doing fee-based on depository accounts. The airlines charge an extra fee for baggage or moving from a middle seat to an aisle seat. So that would be one example how to move the dots. Here is a similar diagram. Now the circle customers are now squares. The vertical axis is how profitable is the customer. The horizontal axis is now the sales volume. So you notice to the farthest right, that's our largest sales customer in sales. Above that, a few more, a little less profit. But look at all of the customer squares in that shaded triangle. They're unprofitable, even though they've got sizable sales. So you really need to be careful. The message here is there needs to be a shift in the CFO's emphasis. Typically, the CFO is pounding on operations, get your costs down. They need to help the sales and marketing better target customers. The spending budget for sales and marketing is critical, but it should be treated as a preciously scarce resource aimed at generating the highest long-term profits for shareholders and owners. So this means answering questions like, which type of customer is attractive to newly acquire, to retain, to grow, or to win back, and which types of customers are not attractive. And for those that are attractive, the next question is, how much should we optimally spend attracting, retaining, growing, or recovering each customer microsegment? And the reason I have optimally in italics is it is an optimization problem. How is it an optimization problem? Remember the subtitle to the Angel and Demon Customers book, Discover Which Type of Customer is Which? Here's the point. You can destroy shareholder wealth creation in 2 ways. The first way is overspending unnecessarily on loyal customers for what is needed to retain them. They would have bought the same volume mix at the same price, but you spend a lot of money whining and dining them or taking extra services. It wouldn't matter, so you wasted money. But you can also destroy shareholder wealth the opposite way by underspending on marginally loyal customers and risk their defection to a competitor. So, it's a customer, but you're not paying any attention to them. You're not contacting them, calling them, being friends with them. They're going to go to a competitor. So therefore, there is optimum spending level, in between, and the good accountants who have skills can basically help sales and marketing with those decisions. Some of you may be saying, Gary, you're beginning to persuade me that we should be doing ABC at our organization, or if you're a consultant for your clients. But your fear is it'd be a mudslide of data. There'd be 2,000 activities in it. Every employee would have to fill out a daily timesheet, and employees hate timesheets. IT would have to extract data from the business systems to calculate the cost. Those are all basically misconceptions. But the result was the systems were too complicated and they failed. I came up with a technique over 15 years ago to implement ABC system in 2 weeks. It starts with model 0 with 6 or 7 cross-functional people and managers in a room. We build a high-level ABC model, not intended to be accurate. The morning of the next day, we bring in the other line managers, the executives, maybe board of directors. They see it. The light bulbs go on with everybody because it's engaging. It's their own company. Oh, that's how we that's how we can see our profit margins. Oh, we can validate our pricing. Oh, we can do benchmarking with apples and apples, not apples and oranges, and so forth. Then a couple of iterations for a week or two, a permanent, repeatable production ABC system ready to be used continuously. Make your mistakes early and often, not later when the system is too hard to change. When the consultants came in and spent 6 months building large systems, and then people started to see it, well, I want to change this. Too late. It was already basically embedded. I love this cartoon. You've got this answer board, simple but wrong to the left, complex but to the right, but right. Notice how few are taking the right path. All the CFOs are taking that convenient, simple way of better spreading the allocations. And notice at the very end, some are falling off the cliff, meaning they're going bankrupt because they've got bad information. All right, let's talk about budgeting. The budget is typically a fiscal exercise by the accountants that has 2 problems. It's disconnected from the executive team strategy. It's not based on future driver volumes. Think of it as sales volume. Let's see how many of these you would answer if I was quizzing you about your annual budgeting process. It's invasive and time consuming with few benefits. It takes 6 months from beginning to end. We started in June, we finally publish it in December. It requires 2 or more executive tweaks at the end, meaning once we publish it, the executives don't see enough profit, go back and make changes. It's obsolete in a couple of months due to events and reorganization, so it's already out of date when you publish it. It starves the departments with truly valid needs. Maybe in this next fiscal year, our department's going to require many more employees. We gave them 2, they needed 20. It caves into the loudest voice and political muscle. This is from, look at me pointing in my head, the gray hairs, excuse me, the ones that have been in there, the company for a long time. They're sandbaggers. They know how to sandbag, in other words, pad their budget because they don't want to be penalized in case they spend more. It incorporates last year's inefficiencies into this year's budget. So our process was inefficient last year. We're replicating it this year. The last one bothers me a lot. When a manager is on a glide path, let's say 3-4 months from the end of the fiscal period, and they can see they're not going to have spent all of the budget that was approved and allotted for them, what do they start doing? They start spending needlessly, foolishly, because they know that their next year's budget is going to be pegged to how much they spent this year. Let me see if I can describe how you do budgeting your organization. You give every manager a spreadsheet, January to December for each of their department expenses, including, rubber bands and paper clips. They all fill it out. Someone in the accounting department then consolidates the spreadsheets. You bring in the forecast from sales for revenues. You produce the pro forma income statement. You give it to the executive. Not good enough. We need more profit. So you give the spreadsheets back to all the managers. They lower some of their expenses January to December. Gets consolidated again, back to the executives. That's a little bit better, but not good enough. Up, down, up, down, up, down, up, down. Come on. You almost want to ask the executives, what number did you want in the first place so we didn't have to go through all of these Excel spreadsheet changes? but that would give us the executives aspirations of what they want. We want to know what can realistically get. So a way to think about how the EPM methods can basically replicate the budget is this way. Think of the amount of money to be spent in the budget is from two river streams. The upper river stream is the recurring repeatable expenses. It's going to be demand driven. Think of it as customer demand, customers placing orders to buy your products and services. The lower river stream is non-recurring, non-repeatable expenses. It's project driven, and all projects, have a beginning and an end. So let's drill down how we can basically replicate it. For the upper river stream, the repeatable work, what we do is we can calculate the ABC system backwards. What I mean by that, is what the historical view, remember the multi-stage cost assignment network, the spending was known. We calculated the work activities cost object, gave us the strategic profitability. But we pick up something very valuable. It's called unit level cost consumption rates for each of the activities. So again, if we had 70 activities, then we're going to have 70 cost drivers. We're going to have 70 unit level consumption rates. Banks, cost per automobile, cost for a policy, manufacturer, cost for material move. With those unit level rates, we now calculate backwards. We estimate the volume and mix. Look at to the left, my equation. I think this was my second semester freshman year at Cornell University, 1967. The sales demand volume and mix times the unit level cost consumption rate equals the capacity required, meaning the number and types of employees with their salary and wage level and purchases with suppliers. So that takes care of the upper river stream. The lower river stream, what we have, I'm going to introduce risk management. This is a popular grid used by the enterprise risk management community. Each of the circles is a risk event that could occur next fiscal year. The diameter is the amount of money to mitigate that risk. Now, the vertical axis is the severity of the impact, very painful. The horizontal axis is the probability the risk event may occur. Now, you can't basically spend money mitigating all of the risk events, but the blue ones on the right, basically, we will mitigate. So if we go back to the upper river stream, we use the ABC system backwards. For the bottom river stream, there's really going to be three types of projects. There's going to be risk mitigation projects. If you remember back to the strategy map and balance scorecard, we had the strategic objectives. We have to spend money on those projects and initiatives to accomplish the objectives, to accomplish the strategy of the executives, and then capital projects, which you're all familiar with. So I've decomposed the upper river stream, lower river stream. The upper river stream are these shaded boxes. We start with the management accounting, we then bring in our unit level consumption rates from the top. From the left, we bring in the forecast volume and mix. That gives us basically a capacity resource plan, number of labor hours, number of pounds or kilograms, number of employees. We then monetize it, whatever is the currency, whether it's euros, dollars, or whatever the currency is in Egypt. That's a good number. Now, from the left, we've got the capital budget projects, we've got the strategy projects, we've got the risk mitigation project. We bring them in. That is a good, valid number. Now, we will still have a sim problem with the executives. Notice at the bottom right, I've got that diamond there that says acceptable. When the executives see that first run, they may say, not enough profit, go change something. The temptation might be, well, why don't we postpone or eliminate the capital projects? Bad. We already justified those purchases with an ROI. Why don't we eliminate or postpone the strategy projects? Bad. Then we're not going to accomplish the strategy. The CEO may get fired. Why don't we postpone or eliminate the risk mitigation spending? Bad. Then we expose ourselves to risk. The only way, the best way to basically lower that profit is unit level consumption rates, meaning productivity improvement. 2%, 3%, 5% productivity on the processes. And that's where the world of Six Sigma lean management fits in. You do need to think like an industrial engineer, because when we do the predictive view to the right, we have to classify the behavior of each of the resources as sunk, fixed, step fixed, or variable. And you'll notice that the variable expense is increasing as we go into the planning time horizon ahead. And examples of that would be we may replace full-time employees with temporary contractors. We may lease assets that we would have purchased, which would mean depreciation expense. So it becomes more variable. Some of you may be interested in a document that I created for the International Federation of Accountants, IFAC.org. They are in New York City. They're like the United Nations of Global Accounting Institutes. I think there's over 50 of them. And they asked me, can I create a stages of maturity of a management accounting that you can make an assessment? And here it is. It's 8 stages. And the document at the bottom, it's called Costing Levels of Maturity. So if you go to ifac.org, you'll be able to basically download this report. But I can just tell you 90+% organizations are a 5D or lower in the stages. 60 is the beginning to use activity-based costing for products and services. 7D, customer profitability. On the right side for the predictive view, most organizations are doing that spreadsheet, up, down, up, down. I showed you the way to go. So how does it all fit together? This is a diagram that I created. The big, large purple box, think of that as your organization. That's your employees and your assets. Look, notice in the customer box at the top, there's an arrow going way to the right, then wrapping around into the shareholders and owners. That demonstrates when I said customers are the source of value creation for shareholder wealth creation. Okay. This diagram, think of it again like your heart and your blood system, where you have veins going through. I'll get to it. I'm going to go into dive deeper, but where's management, accounting, and analytics in my diagram? I deliberately did not put it in because the output is the input elsewhere. So how does the diagram work? Well, if we start with the customer satisfaction to the left, there is the strategy and mission formulated by the executives based on needs of customers. Going down, they'll communicate it to employees with scorecards and dashboards and KPIs. That gives us the feedback mechanism. Notice the KPI scores feedback. Remember that question, how am I doing on what's important? Now, look at the CRM. That's for customer relationship management. That's the targeting of the customers. Which type of customer is attractive to win, acquire, and so forth. Now, the backwards counter circle, that's the process people. Take the customer order, complete the order. That's the most universal end-to-end process, order fulfillment. So see all these little dots flowing through? This is happening every minute, day, week, month, year. But to the degree that any of the processes are inefficient or we're targeting the wrong customer, notice the money doesn't go all to the shareholders, it leaks into the sewer. So I'd like you to think of this diagram as the vision of where you want to be. Now I'm going to conclude, and then we're just going to have a couple of minutes for a question. A frustration I've got, what is taking so long? Why is the adoption rate for these methods? Because it's really low. The first one are technical barriers, such IT related, like dirty data, low quality input data, but IT has a tool called extraction, transform, and load, ETL. It's like a water purifier. It can clean it. Second, the perception barrier of excess complexity. I already described to you with rapid prototyping, you can build an ABC system in 3 weeks. I didn't describe, there's a strategy map balance scorecard workshop that I create that you can have your balance scorecard KPIs in 1 day. Again, any consultants wants to learn this, send me an email. But the real obstacle has got nothing to do with technology, software systems, it's people. It starts with resistance to change. It's human nature. People like the status quo, don't rock my boat. Fear of others knowing the truth. Oh, I don't want other departments to know my costs. Fear of being measured, fear of being held accountable. These are, so you need some behavioral change management skills if you want to implement these. So one of my books to the left, I've got these greasy, grimy, broken gears, if you will. Teeth are broken, they may be disengaged. Imagine you put that into your automobile. What would your fuel efficiency be? Very low. Now look to the right, titanium gears, spinning, faster revolutions per minute, all the gears meshed together, lubricated, digitized. Put that in your automobile engine. Now what's your fuel efficiency? Much higher. Now replace the analogy metaphor of fuel efficiency with rate of shareholder wealth creation. That's what all of these integrated systems do. You make the revolutions per minute of those spinning gears go faster, better, faster, cheaper. That's the process improvement. Safer using risk mitigation and enterprise risk management. Smarter using strategy map balance scorecard. So finally, action steps: get educated, get buy-in. Thank you. You're doing that by listening to this webinar. Rapid prototyping, start small, think big. Improve incentives. I don't have expertise in motivational theory, but it is important. And below are 4 links to articles. So your success depends on how well and how fast the right information intelligence gets to the right people. So Mohamed, I'm going to send it back to you, but I do always believe it's important to end exactly on time. That's what it's a professional courtesy. So we've got, I think, 3 minutes. Are there any questions? And then you can also do your wrap up.
Thank you very much, dear Gary Cokins, for your contribution and your effort. It's really an excellent presentation. Thank you very much. Now, if anyone have any questions, you can open your mic and ask your questions. Yes, Masoud.
Hi, sorry. Hi, thanks very much for this detailed presentation. Can you hear me?
Yes, I can.
Right. I was just wondering, because you mentioned the ABC and the balance scorecard. I was just wondering, how do you overcome the conceptual flaws in the balance scorecard?
I'm very big on rapid prototyping, meaning you create a very fast model that doesn't need to be accurate or perfect, but it's enough that people can get an impression. What will this look like in our organization if we spent more time and did it more slowly? I always call it 18 holes of golf on a polo horse. So that's that's a way to get buy-in.
Because I believe I'm familiar with the balance scorecard, and I am going back many, many years. I was at a management accounting conference in Belgium for the manufacturing sector, and Professor Kaplan was one of the key speakers there. And I was surprised to hear him. I was in the room, and I didn't think it was a slip. I think he meant to say what he eventually said, which is that the balance scorecard he did not invent. He said he came across it in a company that he was consulting for. And then later, when I obviously, as a management accounting academic and teacher and so on, then I started looking at the balance scorecard, particularly those arrows that link the generic boxes, and something that always puzzled me. And I said, why are those arrows double-headed? And so, and then I said, how do you do this? Like it's like a reciprocal relationship, and which one comes first? And I don't think I've ever been able to find an answer.
Well, we're almost out of time and we're going to end. My arrows were not double-headed. Mine go from bottom to top because it's cause and effect. The causality principle is universal, even in accounting and management accounting. You want cause and effect relationships. So I don't understand the double header. I will say this, many organizations have way too many KPIs. They'll have like 300, and I ask them, how can they all be a K? A good balanced scorecard will only have 50 to 60 KPIs. All the other measures are okay, but they're operational measures. So I do want to end on time. It's just a courtesy. People signed up to end at whatever your time is, 6 o'clock or 5 o'clock. So Mohamed, and also, sir, feel free to directly email me. I can send you articles that I've written on Balance Scorecard, links to content I've written. So write my email address down, gcokins at Gary Cokins, and everybody else. So Mohamed, could you do some closing remarks?
Yeah, thank you very much, dear Professor Jerry Cookins, and thank you very much, everyone join us today. Thank you very much for taking the time to present to us, dear Cookins. Thank you. It's been really appreciated. Thank you very much. Goodbye. And I hope to see you soon in Egypt. You are very welcome.
Thank you. I have been to Alexandria and Cairo a few times during my business career.
Yeah, you're very welcome.